Thanks a lot, John, for that very generous introduction. And thanks for the invitation to be here today. It's a real pleasure to be back on the farm. And I have to say there's been lots of changes. I've been away only 6 years, but somebody took away my parking spot and put up a building instead. No, I think this building is a fantastic addition to the economic scene here on campus. So my remarks today, I'd like to touch on several topics. I'll begin with a quick description of the structure of the Federal Reserve System and the deliberative process of the Federal Open Market Committee, the committee that makes monetary policy for the nation. Then I'll describe the FOMC's objectives. Next, I'll discuss how the FOMC can enhance the pursuit of its objectives by formulating what I'll call a public contingency plan based on what I'll term a mandate dashboard. Finally, I'll close with a discussion of considerations for near-term monetary policy actions. After that, I'll be pleased to answer any questions you may have. And before I begin, I should remind you that my comments here today reflect my views alone and not necessarily those of others in the Federal Reserve System, including my FOMC colleagues. So let me start with some basics about the Federal Reserve System. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank represents the 9th of the 12 Federal Reserve districts, and by area, we're the second largest. By population, not the second largest. We're the smallest by population. Our district includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. So 8 times per year, the FOMC meets to set the path of monetary policy over the next 6 to 7 weeks. So all 12 presidents of the various regional Federal Reserve banks, including me, and the 7 governors of the Federal Reserve Board, including Chairman Ben Bernanke, contribute to these deliberations. Now, I said 7 governors, but currently there are only 5 governors. 2 of the positions are unfilled. However, the committee itself consists only of the governors, the president of the Federal Reserve Bank of New York, and a group of 4 other presidents that rotates annually. So right now, that last group consists of the presidents from Minneapolis, Philadelphia, Dallas, and Chicago. But those 4 people rotate off after the next meeting, which is in December, and in January, a new group of 4 presidents will take their place. I've said that the FOMC meets at least 8 times per year. But how do these meetings work? So at a typical meeting, there are 2 so-called go-rounds, in which each president and each governor has the opportunity to speak without interruption. And the first of these is called the economics go-round. It's kicked off by a presentation on current economic conditions by Federal Reserve staff economists. Then the presidents and governors describe their individual views on current economic conditions and their respective outlooks for future economic conditions. The presidents typically start by providing information about their district's local economic performance. And we get that information from our research staffs, but also from interactions with business and community leaders in industries and towns from across our districts. So that's the first go-round, which is all about the economy. The committee then turns to the second go-round, which focuses on policy. And again, the staff begins with a presentation of policy options. After that, each of the 17 meeting participants has a chance to speak on what each views as the appropriate policy choice. This set of remarks is followed with a summary by the chairman, in which he lays out what he sees as the committee's consensus view for future policy. The voting members of the FOMC then cast their votes on this policy statement and thereby set monetary policy for the next 6 to 7 weeks. I think my description of an FOMC meeting highlights how the structure of the FOMC mirrors the federalist structure of the United States government. Representatives from different regions of the country, the various presidents, have input into FOMC deliberations. And as I've described, their input relies critically on information received from district residents. And in this way, the Federal Reserve System is deliberately designed to give the residents of Main Street a voice into national monetary policy. So that's how a meeting works and what some basics about the structure of the Federal Reserve System and the FOMC. And I talked about how meeting participants, FOMC participants, seek to adopt what they view as the appropriate policy choice. And that provides a natural segue into my next topic, which is the policy objectives of the FOMC. The FOMC has what's called a dual mandate established by Congress. It's to set monetary policy so as to promote price stability and maximum employment. And the heart of the price stability mandate is the Federal Reserve's inflation objective. The FOMC communicates its objective to the public in a number of ways. Most prominently, at quarterly intervals, FOMC meeting participants publicly reveal their forecasts for inflation in the longer run, maybe 5 or 6 years, under the assumption that monetary policy is optimal. And those forecasts for longer run inflation, 5 or 6 years out, usually range between 1.5% and 2%. And so they're often collectively referred to by saying that the Federal Reserve views inflation as being mandate consistent if it is running at 2% or a bit under. Okay, so that's on the price stability side, we have this inflation objective, which is understood to be in the longer run to be between 1.5% and 2%. Or really, I guess a better way to phrase it is 2% or a bit under. Congress has also mandated that the FOMC set monetary policy so as to promote maximum employment. And an important and ongoing communications challenge for the committee is it is much harder to quantify the maximum employment mandate than the price stability mandate. Changes in minimum wage policy, demography, taxes and regulation, technological productivity, job market efficiency, unemployment insurance benefits, entrepreneurial credit access, and social norms all influence what we might consider maximum employment. And I think it's important to keep in mind that these changes in in maximum employment can be short run or long run in nature. Like the rest of my colleagues on the FOMC, I expect unemployment to normalize at between 5 and 6% in the longer run under optimal monetary policy. But I want to stress that that estimate of long-run unemployment does not reflect my assessment of the current level of maximum employment. Over the past year, the FOMC has communicated through its statements that it perceives the current unemployment rate to be elevated relative to levels that it views as consistent with its dual mandate. In this situation, there is a trade-off involved in the making of monetary policy. On the one hand, adding monetary policy accommodation reduces unemployment, other things equal. On the other hand, adding accommodation increases the risk of generating inflation markedly higher than the committee's objective of 2% for a significant period of time. In choosing whether to add monetary stimulus or not, the committee must resolve this trade-off between reducing unemployment and increasing the risk of inflation. So those are the committee's objectives and sort of the trade-offs that it faces. So in particular, I've described how an FOMC meeting works. I've described the objectives of the committee, and I've described the tensions that currently exist between those objectives. I now want to turn to the formation of policy designed to achieve the FOMC's objectives. So right now, the FOMC has two types of what we call accommodation, monetary accommodation in place. First, it is targeting a short-term interest rate, the federal funds rate, between 0 and 0.25%, 25 basis points. And it plans to keep that interest rate that low at least through mid-2013. That is, at least for the next 6 to 7 quarters. This low interest rate is intended to stimulate consumption by households and investment by firms. So that's the first kind of accommodation, low interest rates that are that are expected to be kept that low for the next 6 to 7 quarters, at least the next 6 to 7 quarters. Second, the FOMC has bought a large amount of long-term government-issued and government-backed assets. Now, these asset holdings are designed to stimulate longer-term investment. More specifically, any holder of a long-term bond is exposed to interest rate risk because the value of that bond fluctuates as interest rates vary. When the Fed buys long-term bonds from the private sector, the private sector as a whole is exposed to less interest rate risk. As a result, some private investors will demand a lower premium for holding other bonds that are exposed to interest rate risk. Consequently, all long-term yields fall, and corporations should correspondingly lower their hurdle rates for long-term investment projects. They should be more willing to undertake investment projects. And the FOMC does have additional tools. It could exert further downward pressure on long-term market interest rates by buying more long-term Treasury securities or securities issued by government-sponsored enterprises like Fannie Mae and Freddie Mac. Alternatively, the committee could extend its prediction for how long it will keep its target short-term interest rate exceptionally low. So tools and choices remain. However, I believe the FOMC should do more than simply decide at each meeting whether or not to buy more assets or to keep interest rates low for longer. Any current decision, I should say, is based on the FOMC's forecast for the future. And no forecast can be perfect. The committee should provide a public contingency plan. That is, provide guidance on how it will respond to a variety of relevant scenarios. I believe this kind of public contingency planning would have many benefits, but let me mention two. So first, without appropriate context, the FOMC's actions may at times suggest that its formulation of its dual mandate objectives have changed. For example, I've spoken to many members of the public who believe the FOMC's current highly accommodative stance implies that the FOMC's inflation objective has shifted upward from that 2% or a bit under that I described. I've certainly argued that they're wrong, but I'm sure that by articulating a clear public contingency plan and sticking to it, the FOMC can inspire greater public confidence that its actions represent the systematic pursuit of its dual mandate objectives. Second, I've heard from businesses that policy uncertainty is curbing their incentive to hire or invest. I've heard from consumers that policy uncertainty is curbing their incentive to spend. An FOMC public contingency plan can help reduce the contribution of monetary policy to this general background of uncertainty. So those are the two benefits of a public contingency plan. Then we come to the question of how should the FOMC actually formulate a public contingency plan? Here I think it's useful to think of a driver who is trying to maintain a car speed. To do so, he'll vary pressure on the accelerator in response to changes in road conditions, current and expected, hills, valleys, rough pavement, headwinds. In the same way, the FOMC varies its chosen level of monetary accommodation in response to changes in current and expected economic conditions. Now, this kind of systematic response to changing economic conditions strikes me as an essential part of good monetary policy for at least two reasons. First, there is a great deal of empirical evidence and theoretical support for the idea that following a policy rule, as economists call it, is what enables the committee to achieve its dual mandate goals. Second, and perhaps more importantly, actions speak louder than words. The committee can claim that it intends to make monetary policy so as to fulfill its dual mandate. But the public can and does watch its actions carefully in this regard. If the committee fails to adjust its chosen level of accommodation appropriately in response to changes in economic conditions, the public may well begin to doubt the committee's claims about its goals. But what conditions are relevant? Again, I think that it's useful to think of a car driver who's trying to maintain his speed. To know how much or know how little acceleration to provide, the driver would certainly like to know his current speed. But as well, he would like to know how future road conditions, like hills, are likely to affect his future speed. And I think the FOMC's problem has been quite similar to this. Just like the driver needs to know his current speed, the FOMC needs an accurate measure of current inflation and unemployment. That's what the dual mandate is about, is inflation and unemployment. So you need current measures of those variables. Just as the driver needs an estimate of his future speed based on anticipated road conditions, the FOMC should have an assessment of the future levels of inflation and unemployment. So I find it helpful to summarize the relevant information in what I term a mandate dashboard. So the dashboard provides real-time readings on current and expected inflation and unemployment. And here's what the dashboard looked like in the FOMC meeting that took place earlier this month. So I'll talk about the dashboard beginning with the inflation side, the left side. And the first cell from the left is current inflation. The second cell is what inflation is expected to be in 1 year's time. And the third cell contains a forecast for inflation in 2 years' time. The unemployment side is quite similar. You've got the first cell from the left represents current unemployment. Second cell represents a forecast for unemployment in a year's time. And the third cell is a forecast for unemployment in 2 years' time. Now, I have to be, I'm talking about inflation and unemployment. I have to be at least a little more precise for this audience about what I mean by inflation and unemployment. By inflation, I mean the change in the personal consumption expenditure price index over the preceding 4 quarters, excluding changes in the prices of food and energy. So what my measure of inflation in the dashboard means is it's really a measure of what's commonly called core inflation. And just to be clear, I think of the dual mandate, the responsibilities of the Fed in terms of price stability as being about headline inflation, that is the rate of price inflation of all goods and services. But I'm using core inflation here because I view it as a good measure of overall inflationary pressures over the next 2 to 3 years, getting rid of some transitory large fluctuations in energy prices in particular. By unemployment, I mean the unemployment rate average over the 3 months in the current quarter. And so these forecasts for future inflation and unemployment are the midpoints of the central tendencies of the projections of the FOMC participants that they released in November. So there's 17 participants. I think they throw out the 3 largest and 3 smallest, and then report the endpoints of that, and then I'm taking the average of those endpoints. Now, I think it's important to note this dashboard includes information from other current variables besides inflation and unemployment. The forecast for inflation and unemployment could potentially be based on a wide range of information. Anticipated changes in fiscal policy, changes in European financial markets, and so on. Basing policy on the mandate dashboard allows policy to react to changes in these other economic variables. But using this kind of dashboard that I have up here requires monetary policy to respond to any economic variable only insofar as it affects current and future inflation or current and future unemployment. So you're not responding just to the change in the fiscal situation for the sake of the fiscal situation. You're not responding to the change in European financial markets for the sake of those markets. You're responding to them because they're affecting your either current or forecast of future inflation and unemployment. This restriction seems entirely appropriate given the limited nature of the FOMC's statutory assignment from Congress. Now, given this mandate dashboard, how should the level of accommodation evolve over time in responses to changes in the dashboard's readings? There are many subtleties associated with the general answer to this question, including the key trade-off that I mentioned earlier between inflation and unemployment, between the 2 mandates. But there are 2 relatively common and important instances in which the mandate dashboard does become straightforward to use in a qualitative way. Suppose inflation and expected inflation rise, and unemployment and expected unemployment fall. That's, as is often true in a recovery. So inflation and expected inflation go up, unemployment and expected unemployment come down. Then regardless of how it weights the 2 mandates, the FOMC should reduce the level of accommodation. In contrast, suppose inflation and expected inflation go down, and unemployment and expected unemployment go up, as is often true when the economy slows. Then, regardless of how it weights the 2 mandates, the FOMC should increase the level of accommodation. So a public contingency plan for 2012, as I talked about, I think it's important for us to spell out what would happen in a variety of scenarios. It would specify the FOMC's actions under a number of scenarios for this mandate dashboard in a year's time. So I'm going to start, I think, at the natural point where the FOMC's projections for 2012 actually turned out to be right. It wasn't meant as a joke. Turned out that way, but it wasn't meant as a joke. Here's what the forecast looks like. In November of 2012, so I should say right up the front, the second cell in the November of 2012 row, so you go to that number 17, which is the second cell over in the November 2012 row, that's the forecast for inflation in 2013. And 2 years ahead would be 2014. The second cell of the November 2011 row is a forecast, that 1.8 in the second cell over in the November 2011 row. That is the forecast for inflation over the course of 2012. So this makes sense. Monetary policy operates with a 1 or 2 year lag, so the dashboard's just keeping track of what we expect the economy to be like in a year or two. Now, if you compare the second row of the table to the first row, you can see under this scenario, under the FOMC's baseline projection, core inflation and its outlook will be about the same in a year's time. Unemployment will be lower. These changes in the dashboard's readings suggest that under the scenario that the economy evolves in 2012 as the committee expects, the committee should actually reduce the level of monetary accommodation over the course of 2012. So inflation stayed about the same, unemployment is reduced, should reduce the level of accommodation. How would you go about doing this? How would you reduce the level of accommodation? Well, I told you the committee is projecting that it's going to keep its target short-term interest rate extraordinarily low for at least the next 6 to 7 quarters. What we can do to reduce the level of accommodation in November 2012 is just change that estimate to a shorter period of time. So instead of 6 to 7 quarters, something shorter than that. Now, as I think the audience has already suggested, the FOMC's projections have proven imperfect over the past few years. With that in mind, the committee should provide public guidance on how it will respond to other scenarios in 2012. So here's another scenario in 2012 in which conditions are worse than expected. Inflation, in this alternative scenario, inflation has fallen since November 2011, and unemployment has risen since November 2011. This would imply you should increase the level of accommodation. So there are a couple of ways you could do that. Again, I've told you that the committee is currently projecting it's going to keep interest rates extraordinarily low for at least 6 to 7 quarters. The committee could increase the level of accommodation by increasing that 6 to 7 quarters to some longer period of time. Alternatively, it could increase in combination by purchasing additional long-term securities issued by the federal government or by government-sponsored enterprises. So I've been talking about how a mandate dashboard can be helpful in formulating a public contingency plan, in particular a public contingency plan for monetary policy next year in 2012. But I think the mandate dashboard also clarifies an important inconsistency in the making of recent monetary policy. So as John mentioned, I became president of the Minneapolis Fed in October of 2009. I attended my first FOMC meeting in November of 2009 as a non-voter. So when I think about current monetary policy, I find it pretty natural to look back at my first meeting and what the dashboard looked like then. So that first row tells you what the dashboard looked like in November of 2009. Conditions were grim. The committee expected low inflation and ongoing disinflation over 2010 and 2011. Unemployment was expected to average well above 9% over 2010 and 2011. 2 years later, the situation, while hardly ideal, has improved markedly. I would say the evolution of the dashboard reading suggests that monetary policy should be less accommodative now than it was in November of 2009. But in fact, through choices dating back to last November, the committee has made monetary policy considerably more accommodative. I should underscore one point. Like many private sector forecasters, as I hinted at earlier, the FOMC has overestimated the strength of the recovery over the past 2 years. And you can see that in in the November 2009 row. So if you go to the, for example, 2 years ahead unemployment rate, the committee was forecasting in November of 2011, in the fourth quarter of 2011, the unemployment rate would be 8.4%. It's actually 9.1%. So this observation does, and I think it's very critical to understand what this observation means, that the committee has underestimated the strength of recovery. It implies the committee's current level of accommodation should be larger than what the committee expected it to be 2 years ago. So we should have more accommodation in place in November 2011 than what we thought we would have in place had things turned out the way we thought they would. It does not imply that the current level of accommodation should actually be higher than what the committee had in place 2 years ago. Now, how should an outside observer interpret this inconsistency between the evolution of the mandate's dashboard's readings and the committee's actions? So earlier in my speech, I set forth what I see as the key trade-off involved in making monetary policy, at least under current circumstances. There's a benefit to adding monetary accommodation. It reduces unemployment. There is a cost to adding monetary accommodation as well. It increases the risk of having inflation run above the committee's objective of 2% for multiple years. The committee's actions in 2011 suggest that it's now more concerned about high unemployment and correspondingly less concerned about the possibility of higher than target inflation. Now, I want to be clear here. I view the committee's current resolution of this trade-off between inflation and unemployment as being a justifiable one. And when I joined the committee in 2009, I viewed the committee's resolution of the trade-off as also being justifiable. What I see as problematic in terms of these actions is the committee's resolution of this trade-off seems to be changing over time. Now it seems like it's more willing in 2011 to tolerate higher than target inflation than it was in 2009. If this drift in inflation tolerance were to persist, or were expected to persist, it could give rise to a damaging increase in inflationary expectations. This is bad on the price stability mandate, of course, but undoing such an increase in inflationary expectations, as Americans discovered in the early 1980s, requires drastic policy steps that have extremely painful consequences for employment. So it's exactly in this sense that I've said in earlier speeches that the committee's actions in 2011 have served to weaken the committee's credibility. I think it's critical for the committee to avoid the further drift in this resolution of the key trade-off between inflation and unemployment. So looking forward, the committee should take actions to avoid further drift in this resolution. I think it can accomplish this goal in part by formulating and following a public contingency plan that is explicitly grounded in metrics like the mandate dashboard. Now, no contingency plan can ever be definitive. Inevitably, the FOMC will learn things that it did not expect to learn. And so there may be conditions that could cause the FOMC to deviate from a chosen plan. But having a public plan and couching your decisions against the backdrop of that plan will enhance Federal Reserve transparency, Federal Reserve credibility, Federal Reserve accountability, and Federal Reserve consistency. In May of 2010, Chairman Bernanke stated, "Transparency regarding monetary policy not only helps make central banks more accountable, it also increases the effectiveness of policy." I agree completely with this sentiment. I see a public contingency plan based on the explicit use of metrics like the mandate dashboard as promoting exactly the kind of transparency that Chairman Bernanke was describing. Thanks a lot for listening, and I'm happy to take any questions you might have.